Welcome to Breaking News to Trading Moves. Today we're looking at the market reaction after Spotify dropped its Q3 earnings. Some really strong numbers in there, but maybe a more conservative outlook than some expected.
That's right. It really created this tension. Great performance right now, proof of the model, but then the forward guidance gave people a little pause.
Okay, so let's get into those headline figures for Spotify. That's ticker SPOT. Q3 beat expectations pretty much across the board. Revenue came in strong, somewhere between 4.27 and 4.30 billion.
Yep, right in that range. And the user numbers are just, well, massive. Premium subscribers reaching 281 million.
But the profitability piece seemed like the real news here. Operating income of 582 million, net income 899 million.
And the gross margin number, 31.6%, that was crucial. It showed the market they could actually deliver profit, not just chase growth, which had been the narrative for years.
Why did that specific margin, 31.6%, land so hard? I mean, it's just one metric, but it felt like a real validation point.
Well, it sort of underpins the whole business case, doesn't it? The big worry was always whether they could grow without just having content costs swallow everything up.
Right, and the royalty payments.
Exactly. That 31.6% suggests they've managed to blend those price increases they rolled out with efficiencies from things like their podcasting investments and ad tech. It shows their pricing power might finally be getting ahead of those content costs.
Okay, so real operational strength shown there. But then came the forward guidance, still projecting growth, right? Monthly active users heading towards 745 million, premium subs maybe 289 million. Solid numbers.
Solid, yes. But the market reaction wasn't pure enthusiasm. There was that wobble you mentioned.
Why the wobble? What tempered the excitement?
I think the market, especially after those price hikes, was maybe looking for a more dramatic acceleration. The guidance felt steady, not explosive.
So the user growth was good. MAUs hit 713 million, up 11% year over year. That's still huge.
Huge scale, absolutely. But the commentary around it hinted at caution, especially globally on the advertising side. Steady just wasn't quite enough to keep that initial share price pop going, I guess. Investors wanted more fuel for higher valuations.
Right. And that mix proven profit now, but caution ahead. That's what makes investors immediately look around at related companies. So our goal here is to trace those moves. Who benefited from Spotify proving its model, and who felt some pressure from their cautious tone?
Okay, let's start with the winners.
First group seems pretty obvious. Other music streaming and audio platforms.
Definitely. Spotify showing it can be profitable at scale gives a lift to the whole category, sort of validates the entire business model for large-scale audio subscriptions.
So that helps Spotify itself, SPOT obviously, but also someone like SiriusXM, ticker SIRI. It suggests premium audio is a solid place to be, maybe especially heading into the holidays.
Yeah, reinforces that consumer resilience. And the second group, and this ties back to that margin discussion, is the music labels and rights holders.
How so? I mean, more paying Spotify subs means more royalties. That's straightforward. Is there more to it?
There is. It's about stability. That 31.6% margin, proving Spotify's financial health, is really good news for the labels.
Ah, okay.
For companies like Warner Music Group, WMG, or Sony, SONY, it's not just about a slightly bigger check this quarter. It confirms their biggest distribution partner is financially sound and reliable.
Makes sense. A healthy Spotify is a predictable partner. Better negotiating leverage for them too, maybe.
Potentially, yeah.
Okay.
It just solidifies that revenue stream. Okay, third group of winners. Programmatic and measurement companies involved in audio ads. The ad tech players.
This one feels a bit counterintuitive, though. If Spotify flags softness in the ad market, why would the ad tech companies win?
That's a fair question. They win because of where the ad money is coming from. It's about market share shift, not necessarily overall market growth right now.
Shifting from where?
From traditional media, especially radio, Spotify's scale demonstrates to advertisers that digital audio offers huge, measurable audiences. As more ad supply comes online, think podcasts. Personalized playlists, the demand grows for the tools to manage, target, and verify those ads.
I see. So even if the total ad pie isn't growing rapidly, digital audio slice is getting bigger, pulling from radio.
Precisely. Capital flows from poorly measured traditional radio into highly targetable, verifiable digital audio. And the companies providing the infrastructure for that win. That benefits the Trade Desk, TD, and Integral Ad Science, IAS. They're the picks and shovels in this shift.
Okay, that makes sense. It's about the flow of budgets. Now, let's flip to the other side. The market losers, the downside moves. Who faces pressure here?
Well, you have to look at who's losing those ad dollars and maybe losing listener time. First up, traditional radio broadcasters.
Yeah, that follows directly from what you just said. Budgets moving away from AM/FM towards digital.
Right. Spotify's scale and its sophisticated platform just accelerate that. Why advertise on traditional radio with limited data when you have proven reach and targeting on digital audio? It puts pressure on companies heavily reliant on terrestrial radio, like iHeartMedia, IHRT, and Cumulus Media, CMLS.
Okay, and then the second group feeling the pinch.
This would be the smaller, ad-heavy podcast and audio players, the ones who rely on digital ads but just don't have Spotify's sheer scale.
And this connects back to that ad softness Spotify mentioned.
Ah.
You mentioned constant currency earlier when talking about their ad trends. Can you clarify that?
Sure. Constant currency just means they stripped out the effects of changing foreign exchange rates. So if the euro got stronger, that might artificially inflate revenue reported in euros. By saying trends were soft or flat after removing that currency effect, Spotify was signaling the underlying global ad market wasn't particularly strong.
Got it. So in a tougher ad environment.
Advertisers flock to safety and efficiency. They prioritize the biggest platforms with the best, most verifiable reach. That's Spotify. Which leaves less for the smaller players, the subscale rivals who haven't maybe proven profitability yet. That's why you saw pressure on stocks like Odyssey, AUD, and again, iHeartMedia, IHRT, because they play in both radio and this smaller digital audio space.
Makes sense. Scale matters when budgets tighten. What about the final category? You call them attention competitors facing rotation risk.
Yeah, this is less about direct competition and more about how investment funds operate. When news like Spotify's Q3 confirms a profitable growth story in one area.
Investors want in.
Exactly. Fund managers might decide they need more exposure to SBOT now that its model looks validated, but to buy SBOT, they often need to sell something else, especially if they want to keep their overall sector exposure balanced.
So they sell other things in that sort of digital consumer bucket.
That's the idea of rotation risk. They might sell holdings in companies perceived to be competing for the same consumer time or ad dollars, even if those companies didn't report bad news themselves. It's just capital reallocation.
So who got caught in that?
We saw some pressure on names tied to broader consumer attention or digital entertainment, like Netflix, NFLX, or Roku, ROKU. It wasn't necessarily about their own performance, but investors making room for SBOT in their portfolios. Swapping out of broader plays for this newly confirmed audio story.
Okay, so wrapping this up, the takeaway for you, the listener, seems to be that the Spotify report did more than just update on one company. It served as a key validation point for digital audio's ability to be both large-scale and profitable.
Right. And that validation immediately forces a reevaluation across related sectors, ad tech, traditional media, other entertainment platforms. The lines get redrawn a bit.
So what's a final thought for people to chew on?
I'd say keep watching that flow of advertising money. The shift from traditional radio to programmatic digital audio is a well-established trend, but Spotify's results give it another push. Pay attention to how companies like The Trade Desk, TTB, perform as that digital audio inventory keeps growing. Spotify proves the supply is valuable. TTD helps monetize the demand.
Great point. Thanks for breaking that down.
Happy to do it.
And a reminder, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.